Welcome to Animal Spirits with Michael and Ben. Nate Garassi shared a chart showing the total market value of the big five stocks increased 266% from the start of 2015 through Tuesday. The value of the other 495 S&P companies rose just 25% over the same period.
Don't you think these companies are so big now we don't even need an acronym anymore? Everyone just knows what they are.
The big five, yeah. So last week, these companies were in the spotlight for a few reasons, which we'll get into in a moment. One was the antitrust hearings, and then I think that was Wednesday, and then Thursday, blowout earnings from Apple and from Facebook. For years now, literally years, I think since 2015, we've been talking about bad breath, how, as shown by this chart, the market is being driven by a narrower and narrower slice of leadership. And is this always the case? Yes. However, this current example is certainly in the extremes. Jonathan Krinsky put some of this into perspective, and I thought that this was really wild. Last week, I think it was Thursday, the NASDAQ was up almost 1.5%. Okay, so the index was up 1.5%, and more stocks fell than gained. So he inverted it and said, looking at it the other way, there have been 645 days since 2004. By the way, that's when they have data back to. 645 days since 2004 that had at least as many net decliners as on Thursday. Oh, it was Friday. I'm sorry. Prior to Friday, the best performance for the index on those days was 67 basis points. Okay, so the previous high on a day where there was 970 net decliners, the previous high for the index for the day was 0.67%. And on Friday, the index gained 1.49%. Quoting Krinsky, the top three most lopsided breadth performance days in the last 16 years have come in the last 7 weeks. And there's a paradox here. And that is this. This breadth thing, the old line about you don't want the soldiers you don't want the soldiers falling too far behind the generals. That really was a worry on the way up. And now it's no longer a concern because these big five have sort of reached escape velocity where it doesn't matter what the rest of the stock market does as long as these don't crash. And by the way, if they do, they're taking the market down with them. But Krinsky made the point that Microsoft, Apple, and Amazon alone are 35% of the NASDAQ 100. And they're as large as the 87 bottom stocks of 100. So really, wherever these stocks go at this point, that's where the market's going.
The numbers are almost impossible to believe at this point. So Apple was up 10%. How the hell can a company that's already over a $1.5 trillion market cap be up 10% in a day? Like, how does that happen? So they had blowout earnings, I guess. So here's the context I used. Exxon was the biggest company in 2010 in the S&P. It was the fifth biggest company in 2015. Now it's down like 30% this year, so it's like the 30th biggest company. But Apple added the equivalent of Exxon on Friday to its market cap in one day.
I mean, it's truly hard to believe.
It really is insane. And yeah, I think you're right that it's probably the way that you think about these things being good or bad, it's becoming muddled because they are so big that I wrote in mid-April that, like, what would have to happen if we get another leg down? And I said, you have to effectively bet against these huge companies. If you want to take the whole market down, the S&P 500, like, you would have to take these big market cap down. So I looked it up on YCharts, has the ability to look through on all the indexes. So the Russell 3000 is bigger than the S&P 500 because it includes all the small and micro and mid caps that aren't in there. So the Russell 3000 is $36 trillion total. So that's effectively the size of the entire U.S. stock market, $36 trillion as of Friday. Those five companies, Apple, Amazon, Google, Microsoft, Facebook, make up 21% of that, $7.8 trillion for those five alone. I don't know what else to say at this point. How
remember Sweep the Leg in Karate Kid?
Yeah.
These five stocks are the leg.
Right. And so you'd have to. But who's insane enough to bet against them at this point? Like this. So last week we talked about how all these things were so similar to the tech bubble. You have day traders and tech stocks going crazy. This is one of the differences. The other big difference that we didn't mention, obviously, is that interest rates are just on the floor. So that's like the huge wild card there. But the companies like this it wasn't like this in the late 90s. I mean, Cisco got huge and didn't last and treaded water. Of course, Microsoft did and came back, but it wasn't like this.
Well, the main difference, and I think we should make the distinction that when we're talking about the pockets of bubbles. We're not necessarily talking about Apple and Amazon. We're really more talking about the Kodaks of the world. And we'll get to that in a minute. But Tom Lee said, we hear about the craziness of this market as the top five are now 22% of the S&P. We just don't see the bubble. The top five stocks are 18% of earnings and more than 80% of 2020 EPS growth. So their market cap share does not seem out of line. And
their really fundamentals are backing up their performance.
So
that's what's so crazy.
So that is probably the craziest part about this. So Apple reported fiscal third quarter earnings. Total revenue was $59.7 billion, the highest ever for the third quarter. And this is so insane. Services are $13 billion. Wearables are $6.5 billion. So services and wearables are 33% of the revenue. The iPhone is 44%. Remember when it was like, what's the next innovation? Can Apple still innovate? Services and wearables went from 0 to 33% in under a decade, and are now they might surpass the iPhone.
And by the way, personal anecdote here, I feel lost if I don't have my Apple Watch on now. I got it, and I'm like, I'm never going to use this thing. What's the point of it? I love it.
The iPhone is now the smallest percentage of overall revenue that it's ever been, with obviously, like I said, services and wearables taking up the lead. So, yeah, these companies are crushing it.
But so that's because they're doing so well. I mean, these companies are effectively monopolies, right? They've basically, if they have competitors come in, they buy them out, or they just take them down, like Microsoft is doing to Slack right now. Slack came in, and Microsoft decided to just build Teams and put it right into their suite of Office products and just crush Slack with their Teams thing, because it's like the same thing.
Do you think that Apple is the least monopolistic of all of these companies? I guess maybe they own the App Store, which they're taking incredible fees from. But in terms of, I guess, if you think about the smartphone being 50% of their revenue or 44% of their revenue, they have tons of competitors.
Yes, I don't see how Apple is. In Google, the easy one with them would be, okay, you have to sell YouTube and just focus on, you already have the search corner. But I understand why they brought them in front of Congress, but are they actually ever going to do anything? Probably not, right? It sounds like the European Union is doing more for anything. I just think it's hilarious that they brought all these tech CEOs in on Skype or Zoom or whatever the other day to talk to Congress, and then 3 days later we hear that Microsoft is going to buy TikTok, the fastest growing social network that there is, the biggest competitor to Facebook we've seen probably since Snap, and it certainly seems like it's bigger than that. It's on its way to being as big or bigger than Instagram. If you're Microsoft, you almost have to do this deal if it's going to be handed to you, but doesn't that just make them even more entrenched?
We got an email from a reader talking about his dad.
By the way, we've been getting some great anecdotal speculator emails. Some of them we can't read, unfortunately, but there's been some good ones. So keep those coming.
He said, I need help with my dad. Basically, he's buying all these stocks. You know the names. He historically has a poor judge of tail risk. He gets greedy for the upside and seems to ignore the downside. How do I convince him of this? I've tried, but I'd love some advice. Okay. My answer, unfortunately, there's really, what do you say?
There's
can't
nothing you can say to these people sometime.
Literally nothing to say. And listen, a lot of these stocks are on fire, and people that are in these names are making a killing. So what are you going to say? Be careful. It's like, be careful. What are you talking about? I doubled my money overnight. Yeah, be careful. Great advice. Thanks. I'll be careful.
That's like trying to talk your friend off the blackjack table after they're 6 drinks in and playing 2 hands at once, and they're winning. They're getting lucky for winning. Like, you're not going to talk them out of that. It's
such a bad position to be in, because let's just say that these names do fall apart. You don't want to be like I told you. I mean, it's a no-win situation. So last week, or was it 2 weeks ago?
I guess maybe you try to help them have some sort of self-discipline or stop loss or something.
That's the best you can do.
Just so they don't get completely crushed if this thing falls apart.
I would say that's good advice. The best you could do is, hey, listen, I understand. This is great. This is fun. You're making a ton of money. But if you have these enormous gains, at least put some sort of stop order in where you're not going to allow it to, go past a certain level. So last week we spoke about my plumber, and Listen, I'm not trying to be a dick. I'm not making fun of these people that are investing in the market, these young traders that are learning and are going to potentially maybe, take a loss. I'm not making fun of them at all. That's not my intention. I think this is terrific. And some of the lessons that they're going to learn this year are invaluable. Will some people take it too far? Obviously. It's more of a commentary on the state of the market than I'm not trying to dunk on these
Right,
people.
this could be tuition. So I look at it like this is like your brothers or sisters where you can talk crap about them, but you don't want other people to. So there was a story in Bloomberg last week, and Seth Klarman, who's this legendary hedge fund investor, talked about how investors are being infantilized by the relentless Fed activity, and he said it's as if the Fed considers them foolish children unable to rationally set the prices of securities, so it must intervene. When the market has a tantrum, the benevolent Fed has a soothing yet enabling response. Then he goes on and says, as with 30-year-olds living in their parents' basement, we can only wonder whether the markets will ever be expected to make it on their own, which is just a jerk thing to say. But
it's very condescending.
This makes me want to totally defend the day traders and be like, you know what? Shut up. Just because you've been wrong, get out of it. You manage billions of dollars and you're rich. Just so what? You've been wrong about the Fed for 10 years. Leave them alone. So that's the thing where I want to you want to talk some sense into these people, but you also want to be like, you know what? They're paying tuition into the market gods right now. Let them do it.
Right.
This is
right.
Whatever.
What's the average account size at Robinhood?
A couple $1,000 probably.
Okay, so let's say it goes to zero for some of these people.
Right.
They're going to take away lessons from this that are
I just think
hard to quantify.
If you're a hedge fund manager managing hundreds of millions or billions of dollars, why do you care about Robinhood?